Welcome to another episode of Rich Dad StockCast. I'm your host, Denney, and if you've been watching the markets lately, you've probably wondered what's happening, what would happen if the bottom falls out, what if there's another crash? Most investors panic, the wealthy prepare, and today we're talking about one of the smartest tools rich people use to protect their portfolios, even profit when things go south, and that's stock options. We're breaking it down with Rich Dad expert Andy Tanner, who teaches this stuff better than anyone else I know. He's great at simplifying. And before we dive in, go to stockcastbonus.com. Grab your free investing tools. If the idea of a stock market crash makes you a little nervous, these resources will help you get smarter fast. Now, let's get into it. Andy, welcome back to the show.
Great. This is such a great topic, and it's timely. Our market is as of this recording, we're bumping our head up against the top again. And I will tell you, the biggest bubble I see is when there's a lack of fear of a bubble, meaning that when they're fearless and they're just buying stuff just out of sight, out of mind at the top like this, it's a great time to be prepared for a pullback for sure.
Speaking of preparation, stockcastbonus.com, what do our listeners receive when they go there?
So important. There is we mentioned this in the last show we did. There is an absence, not just a lack of it. There's an absence of action for many people in their lives, where they love edutainment, but they don't have an equivalent amount of action in their learning. They're learning a lot, but they're not doing a lot. And I think that's one of the downsides of social media is it feels good to dream and think and learn, and it's entertainment of a form. But there needs to be a preponderance of action that's even greater. If I learn and don't do, I struggle. So at stockcastbonus.com, there's things that are very specific to do. And you download those goodies that are there, read them, and follow instructions of doing. And that's what reading about real estate doesn't make any money. Buying real estate, putting a renter in there and getting cash flow does. And so you learn how to do it, but there has to be some doing along with the learning. And I look at the amount of screen time people are having right now. It's like, well, that's great. They're trying to learn so much, but the doing is where the money is going to be found. So if you are feeling excited about the idea to actually have real money come or an increase of real money come, then that's why you go to stockcastbonus.com. Get that free bonus, download it, and just start following the instructions. Step 1, step 2, step 3. Let's go do stuff.
Very
so
good.
That's it.
Okay.
Yeah.
Now, stock market crashes. Let's start with the big question. Why do crashes blindside so many people?
Because they're stupid.
Right out of the gate. I love it.
No, I'm usually not that abrasive, but I guess I'm getting old and crotchety in my old age. Because they're stupid. Look, first of all, stock market crashes are nothing but awesome. They are what I love, what I hope for, what I pray for. And when you get a big one, life-changing, because that's when you buy stuff. Stock market crashes are temporary. They always have been. They always will be. The market is not going to go to zero and then we'll go back to, living in caves and reboot and start all over. And, everyone's going to be farming now. Look, people need stuff. They need lumber to build houses. So they need a railroad to put it on. So go buy a railroad, just like in Monopoly. Buy the railroad. That's what Buffett did. None of the real estate works without a railroad. What are you going to haul the steel on an airplane? You put it on a truck. How are you going to do lumber on an airplane? It's going to go on rail. It goes from rail to truck to job site. That's how it works. Food. How are you going to get your grain? How are you going to feed 300 million people? Are they all going to starve? No, we'll figure it out. So when stocks crash, that's not a function of people not eating anymore, buying clothes anymore, needing shelter anymore, needing electricity and communication anymore. It's a function of inflated prices where people have just been paying too much for the business. That's all it is. It just readjusts it, and it usually swings the pendulum down even lower. So first of all, before we talk about protecting yourself from a stock crash, what you really, really want is something that'll fill your coffers with freaking cash with the stock crash and do what Mark Cuban did, which is buying puts. The idea of the crash, like, in the last segment, we talked about some stocks. So I'm not selling any of my stocks in the crash. Are you freaking kidding me? That'd be the stupidest thing in the world. Oh, let's say I knew there's going to be a crash tomorrow. Would I sell my shares? No freaking way. If I sell my shares, the stuff if you have a Roth, you won't get taxed, but you can only put so much in a Roth. I'm not going to pay capital gains tax, the same as real estate. Kenny McElroy isn't going to sell projects because he doesn't want to pay taxes on it. I'm no different. It's a generalized principle. Taxes suck, right? We don't want to pay them. That's generalized. That's true in all cases and all times. I don't want to pay taxes. And I don't want to sell my shares. If I sell my shares, I lose my cash flow. That's even more important. I don't get the dividend anymore. And you take some stocks, like they call them dividend kings, right? These stocks have paid a dividend. Like I have a stock that I bought at 40. It's down in the high 20s. It's paid for itself way years ago. And what's crazy is their dividend, they've paid a dividend even in dire straits when this company's gone through problems. They paid a dividend since 1912 and never missed. 1912. Look at all the ups and downs you've had and booms and busts since 1912. That includes the Great Depression, still paying the dividend, 1912. They're certainly not as bad as they are when we had the Depression. So I'm not selling my stocks. What I will do is buy puts. And puts could offer protection if you care about that sort of thing. But what more important is they have the potential to fill your coffers with cash. So when you do, your balance sheet stays the same. You still preserve all your net worth, but you have cash to buy at new low prices. And that's the bigger deal, is you have cash to buy at new low prices. So we could talk about this maybe in the second half, and I can give you some specific examples, but it's pretty easy. You buy insurance, and that's all a put option is. It's insurance. And Robert has a book called The Unfair Advantage, right? Unfair Advantage, The Power of Financial Education, Unfair Advantage. And he was kind, said, Andy, write a little bit in a couple of chapters. And the question he asked me was the difference between an amateur and a pro. And I said, well, my opinion is that amateurs try to get a capital gain. They're in the buy, like I said, they're stupid. They're trying to buy high or buy low and sell high. And they're like, where's the crash so I can sell my stuff before? And all that does is exacerbate the crash. And then they protect themselves through diversification. They say, well, I'm just going to buy everything. Well, in a systemic market crash, that doesn't do anything for you. So the pros, I said, they focus on the cash flow and they protect themselves with insurance, with contracts, is what I said in that book. And I feel the same today. I haven't changed. A put option simply gives you a choice. That's another word for choice is option. Put option gives you a choice to sell high if you wanted to. And as those stocks fall, let's say a stock goes from $100 to $5. Well, if you have the right to sell at 100, you've got a guarantee that you could sell that stock at 100. You don't need to own the stock. You could go buy it at 5 and sell it at 100. Therefore, that contract has what we call, a little jargon here if you can stomach it, intrinsic value. And you don't have to touch the stock. You can sell the contract, be flush with cash, buy even more shares at the low price. And that's just how it's done over and over and over and over again. So insurance is how you deal with a market crash, and you take that insurance and you buy more stuff with it cheap.
Very good. Let's do this.
Before we go to break, I got to throw this in here. Last episode we recorded, I was talking about ExxonMobil, and I wanted to buy it at 55. And I wound up buying it about 43. So what's that? $12 even cheaper. Why? Was it started to fall. I didn't know COVID was going to happen. I had my eye on it anyway. I wanted more shares because 55 is a freaking great price right there. Well, what's it at today? 109. So I'm buying at 55. Once it hit 55 and I got paid to buy it, so I got paid a little bit of money to buy it at 55 by selling a put. So I'm like, man, COVID might drive this further. So I bought a put, and as that went down, the intrinsic value of that put went up $12. The stock didn't get to zero. It got to the high 30s, I believe. And I decided to sell that put. So my cost basis was around 43. Well, I took that cash, right, from the put and applied it towards the stock, and you make more money and you could buy more shares. So that's how that works. And is it difficult to learn? It's awfully simple if you get it. It's simply awful if you don't. And that's where you want to learn from trusted teachers, right? Because there's too much misinformation in the information age. That's what worries me. Fun, simple, and real has never been more important. I never realized the real part was going to be so big because I didn't know AI was coming. When I put my company values that education be fun, simple, and real, I didn't really realize how valuable real would become once AI. I didn't know we were going to have AI. And when I get on Chat GPT, I'm mortified at what it tells me and how bad it's gotten. Because why? Where does it get all its information? From the body of knowledge and misinformation that's out there. So you gotta have fun, simple, and real.
Very, very true. Well, let's go to break. We've talked about why most people panic and lose money in a crash, but now we're going to flip the script. When we come back, Andy's going to break it down for us how stock options can actually protect you and even help profit when the market's in a free fall. And if you're serious,
give examples.
I want to prod you with some examples here, but anywho, go to stockcastbonus.com. We've got some free tools and resources over there for you to help take control of your investing future. If this sounds like foreign language being spoken, just go to stockcastbonus.com. You'll receive some great resources there. Stick around. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad StockCast. Today, we're talking about how to protect yourself from a stock market crash, and now we're getting tactical. So, Andy, what exactly are stock options? We talked about puts a little bit, but just a little refresher. What are stock options, and how do they protect us?
Stocks options gives the owner of the option the right but not the obligation to trade that stock at a specific price. For a specific time. So it's basically an insurance policy, and you can insure yourself to, and I love that word insure because the word is sure. Think about that. The defining characteristic of stock prices might be unpredictability. So if you're going to delve in an arena that has prices change and you care about that sort of thing, to have some surety to balance the unsurety is worth paying for. And so insurance means that I'm not sure. I don't think that my house is going to burn down, but I'm not sure that it won't. So I'm going to buy some insurance so I can have some surety that if it does burn down, it won't matter. Okay, a stock price. I'm not sure the stock price will go down, but I think it might. Well, I could buy some insurance so I could get some surety. So it's I would not be excited about being in stocks if I didn't have options. I really wouldn't. If someone's in stocks and they're not in the options world, they're leaving money on the table. They're leaving protection on the table. Why not bring surety to the unsureness if it's available? So that's all a stock option is. It gives you choices at what prices you'd like to trade your stocks at. And if you'd like to ensure that you can buy it at a certain place, or you'd like to ensure that you can sell at a certain place, and you care about that sort of thing, then options are a way to do that. And for a very small amount of money relative to the stock, you can guarantee your ability to buy something or guarantee your ability to sell some. It's your choice. You don't have to, but you can guarantee your ability. You have the right, the ability, but not the obligation. It's a choice. And choice is good. Who doesn't want choice? So it gives you freedom. It gives you protection. The Chicago Board of Options Exchange in Chicago used to be what they call open outcry. Before we had great computers, it's in the 70s, early 70s, people would, sell, buy, they'd have hand signals, they'd fight. Like in Ferris Bueller, they go in Chicago and they go see the options exchange, or like in trading places when they go to the commodities, supposedly it's a little Hollywood there. The two largest options pits when it was open outcry was the SPX options pit and the VIX, the volatility index option pit. And now it's all electronic, but they're still the highest volume. And the reason those are the two largest is that's where the protection is purchased. So you can buy a put option. We'll give an example. You can do this two ways. You can buy a put option to insure against a drop in a specific stock, or you can buy a put option to insure yourself against a big drop in the market, or you could buy a call option on the VIX that if volatility spikes, you could make a lot of money. So those are the three basic ways you could start in beginning to understand those three opportunities. So that's what an option is. An option gives you the right but not the obligation to trade a stock at the price you choose for a time period that you choose. That's what it does.
Perfect. All right. So with that context, we know what stock options are. Now, how can we use, let's say, puts to hedge against a crash? And is there any stories, any real world examples that you could add to that?
And my favorite story on this is Mark Cuban. Not because he did it any better than anyone else could do it, but it's so big and such a cool part of his story. It's just a great story to introduce people to this. So Mark Cuban, I don't know him personally. I haven't met him. I'd like to. I like Mark Cuban. I think he's cool.
I had a little email back and forth with him once, but that's another story for another day. Yeah. Cool guy.
He sue you or something, Del? Is that what happened? You got sued by Mark Cuban?
No, I complimented him on his book, and he wrote back, and I was really surprised by
really?
it. Yeah,
that's cool.
Yeah,
but I like Mark, and he bartended. He did a lot of stuff, and he started a technology company for that would do baseball games and sporting events called broadcast.com. So if you couldn't get your baseball game on ESPN or ABC, Wide World of Sports, you tune in on the internet and watch your baseball game. So at this point, before Google was big, the biggest search engine at the time was Yahoo. This is in the 90s, and Yahoo's making money hand over fist. And their stock price probably, I've never heard him talk about what the price is, but I'm going to guess about 100 based on the timeline. So somewhere around $100. And he was really smart. He did two things. It was kind of a 1-2 punch. This is probably too much information, and Robert get mad at me for going into jargon and going small. But this might be worth it. There might be a big picture lesson in this small example. So Mark sells this company for like $5.7 billion in stock. So Yahoo is going to buy broadcast.com, make it part of Yahoo, what Yahoo owns. They're going to give Cuban $5.7 billion. Now, he doesn't get the whole $5.7 billion because he started his company by bringing talent that he'd pay him with equity, which is another whole lesson we could talk about. Is I did the same thing when I started some of my companies. Is I had no money to start the business, so I'd get partners, say, look, I've got this great idea. I can do this, you do that, and we'll share an equity. And he did a lot of that. So a lot of these guys became millionaires on paper because now they have this Yahoo stock. I think Mark was over $1 billion. Most of it was his. The largest share. So I think he was over $1 billion. So here's got $1 billion in Yahoo stock. And he's kind of looking around. He traded before. He knew how to trade stocks and options. He was savvy. And he's like, man, I have to be vested for 6 months, meaning that they won't let me liquidate this. They want me to liquidate my shares and cause a problem with $1 billion of Yahoo stock. So they give him a 6-month vesting period, and he doesn't want that to crash. Now think about that. People worry about selling their stocks because there's a crash. He couldn't. So not only was he vulnerable to stock price going down, there's nothing he could do but watch it go down. So it's kind of like all of a sudden you drive home and your house is on fire. It's beyond repair. You can't even turn on the water faucet to put it out. You just got to watch it burn. So your only hope at that point isn't to prevent the fire or stop the fire, is to have insurance. So Cuban went out and he had a few $1 million from the business, in cash. He said he spent every dime he had on insurance. Like all his money went into a 6-month insurance policy on those stocks. And he lost all the money because it didn't crash. He lost every dime, which is absolutely brilliant because that's what insurance ideally would be. You'd actually buy insurance hoping not to use it. I had one guy, I told that story once, some freaking numbskull put in the chat, doesn't look like he's very smart buying insurance. I'm like, I almost want to say, dude, do you insure your car? And did you make money on that last month? Did you insure your house? Did you make money on that last month? Well, then either you're a moron for doing what he did, or if you don't have insurance, you're a moron for not having insurance. Yeah, I don't know. Maybe I'm just going after people today. That's not my personality, call people stupid and morons in the same episode, but they are. So anyway, gosh, man, say it how it is. Got Robert rubbing off on me here.
I see that. Yeah.
So Cuban, the insurance policy runs. Well, now he can sell it. Now he can sell if he wants, but he's not going to sell it. He's going to do something pretty smart. He sold some call options. So that means he promises to sell it if it goes up. He'll get even more. Instead of selling at this price, he promises to sell it up here and he gets paid to do it. That's pretty smart. If you want to sell it anyway, promise to sell it higher. Then he took that money and he used that money to buy the insurance. So he had the market pay for his own insurance. That's called a collar trade is what it is. It's their name for it. It's not like he invented it. It's called a collar trade. But he knew. He was educated. He knew what he was doing. Well, when the stock plummeted, I think it went down like $8. Those puts, in his words, were, quote, worth a fortune, unquote. And so he didn't have to mess with the stock. I think he did exercise them, but those puts were worth a fortune, and now he has cash. He can cash those in or trade them in, liquidate them. And then you got a couple of $1 billion. He actually overinsured. In his 60 Minutes interview, he says, I was covered, like insurance coverage. So I was covered and then some. So that tells me he had maybe some speculative puts on there maybe. And then he went out and bought the Dallas Mavericks, and then he sold them. Now they're the Alice Mavericks because they play no D. So there you go. It's, and the rest is history. So you could do this in two ways to sum it up. You could buy individual puts on your own stocks if you were worried about them going down, cash in the insurance. For me, I would buy puts on a stock I owned, but I'd never sell the stock. I just get compensated for the drop. I'd still want the asset. Then I'd sell the put I'd bought and buy more shares at the low price. That's how I would do it, or seek to do it. The other way you could do it, though, let's say that, President Trump came out and said, oh, we're going to do more tariffs again. We have that big 9% drop, or, whatever hits. It could be anything. It could be whatever. If you need to do it quickly, you could do this with SPX and just buy puts on the whole thing, the whole S&P. And as it fell, that would compensate you, but you'd need to know something called beta weighting, and there'd be some other things to learn there. But that'd be an emergency insurance policy you could buy to seize the opportunity, the downside, protect yourself. But again, you don't need to liquidate. It's not like pure insurance where, like, my son got hit by a lady last week. She stole a car. They spiked her tires. She runs this red light and bam, hits my son. Totals both cars. She dies. He walks away. Unfortunately, she lost her life. She did not survive her injuries. Well, the insurance company now gets a beat up car, right? They'll come pick it up and they'll pay me for this lousy car. Well, the truth of it is, it doesn't work exactly like that in stocks. I don't have to give up my stock. I can sell the insurance and keep my stock. And it's damaged, right? It's fallen down, it's damaged. But the company really isn't damaged, only the price is, and the price can repair itself. So I don't lose my stock when I insure it. When you get a fire in your house, it sucks because the house doesn't repair itself. You actually have to spend the money to repair the house, but you don't have to spend your insurance money on your stocks. you can pocket that insurance money and let the price repair itself, which it always does if it's good company. It's cool. Should you learn it? Yeah. The biggest lie that little voice would be, Blair Singer's little voice. The biggest lie someone would say this. There's two lies. This is too hard for me to learn. That would be, lie number one. This is too difficult to learn. Number two, I would never be able to do this. Lies. I've taught my kids in the 8th grade how to do this. They understood put options when even younger than that. So anyone can learn this with the right, teaching and the right teacher. And that's just how it is. There's no excuses.
All right. So my final question is that if someone wants to learn how to use options responsibly, I'm going to say that keyword responsibly, where should they start?
Well, I have a class called the 4 Pillars of Investing. That's where they should start. And then go to my website and enroll in that class. But the real class they'd want to work up to, and it would take some work. Like if people want to watch a 10-second, short on TikTok, good luck in learning how to do this on that or from your brother-in-law. But if it's like the guy that teaches my advanced options class is Corey Halliday. He's a Series 4 option principal. He managed floors of hundreds of traders, big time aggregate risk. I would want to listen to him more than my cousin-in-law who thinks they know this, because someone who thinks they know this doesn't know it like Corey knows it. And so Corey and I and Noah, we built this class called ARMOR, Advanced Risk Management Opportunity Readiness. That's what ARMOR stands for. Advanced Risk Management Opportunity Readiness. That's the class you really want if you want to protect yourself in a crash. That's the one. And it is the freaking granddaddy. It is awesome. But that would take some effort, right? If you want to be good at something, put effort into it. If you want to be interested in something, get superficial information from your cousin-in-law. But Corey is the best guy. Corey is the best guy on the planet to learn this from, because he not only knows it, he knows how to teach it, which is equally important. Knowing it's one thing, being able to teach it is quite another. He's fantastic. So I'd learn from Corey Halliday.
There we go.
That's who I do learn from, is Corey Halliday.
I love it. Well, that wraps up today's episode of Rich Dad StockCast. The reality is this: stock market crashes happen, but you don't have to be a victim. With the right tools and the right education, you can protect yourself. You can even thrive in it. And a huge thank you to Andy Tanner for breaking this down so clearly. You simplify it as well, at least for me. And listeners, if you want to go deeper, go to stockcastbonus.com. You'll find free tools and resources and education that'll help you build smarter, safer investing strategies starting today. And make sure you subscribe, leave a review, share this episode with someone who's worried about the next crash. And thanks for listening. I'm Denney. Stay smart, stay invested, and we'll see you next time.
This podcast is a presentation of Rich Dad Media Network.